Hello everyone, how's it going? In this video, we're going to analyze DraftKings. We look into both the bull case as well as the bear case scenario, and there's some interesting points to cover. Number one, the bull case. Jason Robbins, he founded the company and he is running the company. Whenever you have a founder along, that's a very good aspect for the company. Basically, there's no one in the world who cares about the company as much as the founder does. So that's a good thing. Now, number two, you have the insider roster, and insiders hold about 7.3% of the company, which is a good aspect. I mean, I would like to see a little bit longer, but 7% is good enough for a company who's sitting at about $32 billion of market cap. Now, they have some skin in the game, so their interest and your interest are aligned in the same direction, at least for some reason. Now, next is Data Roma. This gives out any super investors who is interested in this company. And there is one super investor who is into this company, and this guy owns about 0.01%. And he runs about a $9 billion fund. So 0.0% with 24,000 shares is probably nothing for him, but something to keep an eye on. Next, you have the bear case scenario. This is basically Data Roma again, and it shows the insider trading. Basically, all these the insiders who are selling and buying companies within their portfolio. Then you have Matthew Kalish, you have Jason Robbins. These two are the most important people in the company. Both co-founded the company and are running the company. And you can see only sales of shares going on for the past few months. Now, Monish Babrai said people sell for a variety of reasons. It could be for anything. But when they buy, they only buy because they think that the company is being undervalued. But here you can see it's only sales going on. So they know that the value is probably very good for them to shell out some shares and make some money. You can see they're making about 11 million, 3 million, 4 million, 15 million right here. So they're easily selling out shares on the behalf of all these investors who are into this company, basically to make the buck out of it. Now, let's look into this. This was a news article, not too much of the investing perspective, but just to keep an eye. It came out on yesterday. So basically, the DraftKings CEO, Jason Robbins, he rented out the Gillette Stadium, the Patriots Stadium in Massachusetts for his wife's birthday. And there were some big celebrities who were invited into this event. And that shows you he is spending out money. And this is a company which has been, it had been in the off market and just came in the IPO recently, and they have been borrowing money in order to survive. It's not a new company; it's a very old company. It was founded back in 2012, so almost 10 years, almost a decade-old company. And this is a company which is not yet profitable, and they're still raising capital in order to survive. And this is a guy who's going on and spending money onto a stadium. But nothing to say on that aspect, but just want to keep it on since we're looking at this company. Next, you have the financials. So this company is sitting at about $39.28, but that's not the price you want to be looking at. You want to look at this price. This is the market cap of the company, which they basically tells you it's about $31 to $32 billion in market cap. So which means if you had some hard-earned money that you spent, you basically have worked hard so for the past few years, and if you have saved up about $32 billion, you could go and buy DraftKings right off the bat at this moment. But if you had 32 billion, is this a company that would you like to invest your hard-earned money into? Let's come back and see what would the money give you back if you were to invest $32 billion. It tells you that it has a revenue of about 226 million back in 2018. In 2020, it had about 614 million. So there's a good increase, about 90% in the year of 2020. Then in 2019, it has 42% increase, and 2018, 17% increase. In 2017, well, basically, they just reported right now. But again, it's an old company from 2012, and it hasn't been profitable at all. So 2012, it's a decade-old company and still hasn't turned into any profit. So it hasn't returned any money back. But even if you just look into from the revenue perspective, and if it was running at 90% growth every year, this growth happened because of the COVID era. It all pumped up all these online gaming and online things that went out. People were sitting in their homes, and this pushed the company very high. So the revenue was really good. We don't know whether this revenue will go on, but let's say, yes, this is a very lucky company and it's going to survive at 90% growth year on year. With that, it'll take about 6-7 years or maybe up to 10 years to get $32 billion in revenue back. Again, it's not profit, it's just revenue. And if it were to grow at about 42 or even 17%, it'll take about 20, 30 years just from the revenue aspect to get 32 billion back. So imagine you put in $32 billion. Are you ready to wait 30 years to get your money back just from the revenue perspective? We don't know when it'll get profitable or when it'll start generating money. It's still in that bleeding stage. People might say, hey, it's a growing company, it's a new cutting edge technology, it's an online betting gaming website, and they are supposed to be shelling out cash, they're supposed to be running out money. But again, that's something to keep an eye for. This is the valuation. This is Crunchbase, and just gives out the pre-IPO, before they came out in the public market, what was that series investing rounds going on. And you can see they've been raising capital from the market, investing capital. In 2013, they raised 24 million, 41 million, 300 million, 150 million, 120 million, 74 million, up until 2019. So this is a decade-old company which still needs capital in order to run and survive. Think about it. This is the picture of safety margin. So that basically, if you're in the construction field and if you're designing a bridge and you know that the maximum load that's going to be traveling on that bridge is going to be 10,000 pounds, you don't build a bridge which is only going to carry 10,000 pounds. You build a bridge with the maximum capacity of 30,000 pounds, even though you know that the maximum weight that's going to be on the bridge would be only 10,000 pounds. And that's the safety of margin. Basically, if something, some fluctuation happened where you're not in control of it, the bridge should be able to carry. And the same thing implies into investing as well. But if you were to invest into this company, whether, right now the market is, in a very good bull case and everyone loves stocks, everyone loves DraftKings. And you can see all the insiders are selling company, their shares because they know they're going to get good buck out of it. The people are doing that, and we know that the company is having a very good margin right now, and everyone loves DraftKings. But 5-10 years from now, so all of a sudden, people are not so much into betting; they're doing something else. And what will happen to DraftKings? Can you and I control that fluctuation? That's where safety of margin comes in. And I'll give you a very good example from this company. I'm giving you, it doesn't mean you go and buy this company, but just to give an example. This is a company, Heritage Growth Properties. They basically own all these Sears properties, and these are very prime location properties. The Sears company, which got bankrupt, all the real estate that was real, these are all good assets and prime locations in the country. This company owns all those properties, and this is at a market cap of $674 million. So this whole company of all these prime locations is available for us to buy at $674 million only. And if you look into the assets that they own, it's about $2.6 billion. With all the liabilities and everything being taken out, you still have about close to $1 billion left for yourself. So if you were to buy this company, instead of buying $32 billion, putting $32 billion into DraftKings, if you bought Heritage Growth Properties for $674 million, and you said, hey, I'm going to lay off everyone. I don't need any staff. I don't need any overheads. I don't need all these offices. I'm going to sell out everything. You will be left with about $1 billion of real estate, prime location of real estate that you can still sell out and get your money back. That's the margin of safety where, Warren Buffett said, hey, you need that in that scenario where if it's head, if you're tossing a coin, if it's head, you win. And if it's a tail, you don't lose much. And that's where safety of margin comes into. But again, these are my thoughts. And I could be wrong. I could be judging the company in the wrong way. But do your own research. Think about it from a neutral perspective. Don't look into the herd mentality of where the market is going. Think from a very cool and perspective mind as an investor. With that, take care. Stay safe. Bye-bye.